Hello, everyone. Hopefully we're in good shape and on. Sorry about some of our situations here. I just got into our session, so just want to work with all of you on those types of things. Good to be with everyone today. My name is Leon LaBrecque, and I'm going to be your presenter. I'll be talking about how the new tax law does change nonprofits and donations to nonprofits. So hopefully we're in good shape, and I'm going to get through and go on that. Background: attorney, CPA, CFP, CFA. I'm the Chief Growth Officer of Sequoia Financial Group. We manage about $5 billion. I do a lot of stuff with our nonprofits, and I serve on the board of several nonprofits as well. Local boy, Troy, been in Troy, member of the Troy Chamber for years, also a director on the Troy Chamber of Commerce. So topics for today. I do want to talk about the new CARES Act non-itemizer rule. I'm going to want to talk about the new adjusted gross income limits for 2020, some bunching, why we shouldn't give cash, how to do charitable swaps, why to use the QCD, and a variety of other things. I do want to start with a really interesting part, and I want to just basically take everybody through. I wish I had $10 donated to each of your charities for every time that we use the word unprecedented. I just want you to understand that I haven't seen anything like this year. Yesterday was a good example too. We had the idea that the pandemic was going to be over quick, which hopefully looks like it is today. Eli Lilly got approved too for an emergency use vaccine. But I haven't seen any year where the market's been so crazy, and I haven't seen a year where the taxes have been so crazy. And there's some opportunities, I think, for charitable giving that we can do with some of our donors and some of our clients. So let's get into some of these things. The first easy one is for non-itemizers. Non-itemizers can now deduct up to $300 above the line. And that's a cash donation only. You're helping others, you're helping yourself. And it's a nice, simple thing. Comes right off adjusted gross income. They get a tax deduction against their income. It also basically makes a tax deduction for Michigan as well. So it's an easy rule, and it's an easy way to get small donations. Probably a more interesting one is there's now 100% of adjusted gross income limitation for cash gifts to charity. So you can now have a donor that wants to gift. They can gift all the way up to 100% of their income. This doesn't apply to family-funded private foundations. It doesn't apply to donor-advised funds, but it definitely applies to a cash-based charity. You can blend those deductions. So you can make a gift of appreciated securities to your donor-advised fund and a 70% gift to cash. Now, why would anybody donate 100% of AGI? They could, because what that would basically do is it would allow them to offset things like a Roth conversion or do some other things, so they could increase their income and then increase their charity and still zero out their taxes. So there's a great opportunity if you have potential big donors that have the ability to make cash gifts or make appreciated property gifts. You could definitely work with them in this fashion. And I think this is one of those areas where talking to professional advisors, talking to the CPAs of our donors, talking to the tax attorneys of our donors makes a lot of sense. And I think this dialogue should happen right away. And I think you should definitely look at the 2020 AGI limitations. That the provision on the 2020 is elective, that you can elect on your 2020 return to default to the 60% of AGI limit and carry over the rest. That might mean for people who are going to be in a high tax bracket next year, they'd want to do that. So there's an interplay of all these other deductions. Most people wouldn't donate 100% of adjusted gross income. Most cases, and I have one client, very, very wealthy client, that is going to donate 100% of her adjusted gross income this year, and it's a significant donation as well. Most of my other clients, I sit there and I do a little tax sharpening, pencil sharpening, and we get them to the bottom of the 12% bracket. And I go, look, let's deduct everything we can deduct, not just charity. Let's deduct our mortgage interest, and let's deduct our state and local taxes, and let's get a little bit of that 0% bracket, and a little bit of that 10% bracket, and a little bit of that 12% bracket, and then let's do the others. But I've coupled this successfully with Roth conversions. And again, I'm going to tell everybody there's never been a year like 2020. I like to say insight is 2020 and hindsight is 2020. There's not been a year like this one. And, candidly, I'd be happy if there's not another one like it for a long time. The corporate giving limits have gone up. The limit of 10% increases to 25% of taxable income. And it also, the limitation for corporate donations goes up on food inventory from 15 to 25%. Big one everybody likes to use, and that's bunching for fun and write-offs. And that's the idea, is make a large donation to a charity or a donor advised fund in a high income year. and use your income to time contributions. And I advise this to clients all the time. So I could give 2 or 3 years worth of contributions at one time. So let's say the Smiths have $10,000 of state and local tax deductions, and they have $10,000 of mortgage interest, and they usually give about $4,000 to their charities. It could be their church or the temple or college, whatever. So their itemized deductions are basically $24,800. They're getting no real benefit from it. But if they gave $12,000 to their donor advised fund or $12,000 to their charity and just said, don't bug me, but I usually like the DAF better, they could get a deduction of $32,000. So I really like this bunching idea, and this would be a great year to do some bunching. We don't know necessarily the complexion of the Senate yet. It is possible they could change some of the tax rules if there's a change in the Senate to the Democrats. You might see some change in taxes, and large income donors would have limitations on their itemized deductions. So another thing to be thinking about, and we won't know the outcome of the Georgia Senate race until January 5th. Another rule I like is don't give cash. Gifting appreciated property, in my humble opinion as a CPA and tax attorney, is superior to gifts of cash in many, many cases. So publicly traded securities are pretty easy to give away. I can give up to 30% of my adjusted gross income. I don't have to pay capital gain taxes. I don't have to pay Michigan taxes on the capital gain. The assets have to be held for 1 year or more. The gift is valued at fair market value, and I can go to a donor advised fund or any other type of charity. So I had a client the other day who had some Tesla stock, and they gave actually in this case, they gave $100,000 worth of Tesla stock. Tesla was up so much. It had a really low basis. They avoided the capital gain. They also got no tax on the gain and got a full deduction. So it really worked out. There's other non-cash assets. You can give real estate. You can give real estate in the form of fee simple or leasehold or remainder. You can actually give conservation easements. There are issues with real estate if there's debt on it. There's environmental hazards, but it's really good for some of the other substantial parts. So if you are looking for somebody to make a gift in real estate, by the way, I'd get working on this right away. You could use it for a charitable remainder unit trust. That would be a good spot for it. I have done this for myself and for other clients, given closely held business interests. This really works great when somebody has a prearranged sale, as long as you make the donation before the sale is formally legalized. Tremendous opportunity for people to give away business stock before the transaction, get rid of the capital gain, get a charitable deduction, fund their donor advised fund, and go through that. Life insurance can be gifted as well. Annuities can trigger gain on transfer, but you can gift life insurance to a variety of other things and make a great lifetime gift. Annuities work as a great testamentary gift. Restricted stock, people who have stock, they're in Aptiv or something like that, one of our local companies that's a publicly traded company, they're restricted. There's an appraisal and a lockup, but it really works great for a planned gift. You can also gift stock options. You can gift things like collectible art, coins, and antiques. You can gift patents. There's some complexity to that. And you can also gift Bitcoin and crypto. I guess the message here is there's lots of non-cash assets. There's stock, and then there's real estate and business interests and life insurance and stock options and collectibles and intellectual property. Lots of ways to get things. I think sometimes it's just the right ask, and that's one of the key things. So here's one I'm hot on right now, and this is the swap. This is where I've got a traded security to a donor advised fund or charity, and I just replace it with the same one. So let's go back to my Tesla guy. He had $100,000 worth of Tesla. It had a basis, his $100,000 worth of Tesla had a basis like a 10 grand. He got a $100,000 deduction. He saved capital gains on $90,000. But he said, but I like my Tesla. And I said, well, just buy it back. So we can do that. I go, yeah, you can gift it away at a gain. There's no problem gifting things at a gain. If you gift them at a gain, there is no loss. There's no wash sale rule. This really works. And I call this a charity swap. And this is a big one. And I've used this with some of my charities that I work with, is that we'll gift. I mean, right now it's crazy. The market is crazy. So you've got stocks that have gone through the roof, like some of the big tech stocks, the Amazons and the Teslas and the Netflix and Google. And you could have a 50, 60% gain in those for the year, provided you held them longer than a year. You could gift those to your donor advised fund and then just turn right around and buy them somewhere else. Buy them in an IRA, or even more fun, one of my favorite ones is the Roth swap. And I'll talk about that one in a little bit. I would buy them back in a Roth. In fact, with the guy with the Tesla, that's what we did. He had a $100,000 deduction. So that was great. And I said, cool, let's take the $100,000 deduction. Let's use it. Let's convert $100,000 of your IRA to a Roth, and let's go buy Tesla in there. And it'll be all tax-free. So that works out real well as well. Use the qualified charitable distribution. This is interesting. There's a direct distribution from the charity to a charity from your IRA. You have to be 70 and a half. By the way, not 72. A new law that came in at the end of last year had the rules on required minimum distributions changed to 72. It's not that anymore for QCDs. For qualified charity, it's still 70 and a half. For 2020, people did not have to take their required minimum distribution, but that doesn't mean you can't make a qualified charitable distribution, and you still should think about doing it. It does reduce your adjusted gross income, which means it's effectively giving you a Michigan tax deduction as well. And for those of you out there in the nonprofit world, man, use this one. This is a big one. You've got donors who didn't have to take their RMD this year, who are sitting there with money in their IRA, and let's say they're smart enough to stay invested. Their IRA is probably worth more than it was at the beginning of the year. And they can now take some of that, give it to charity in terms of a QCD, and it reduces their adjusted gross income. It also reduces the floors for Social Security. It reduces the Medicare B and D floors. It reduces the college credit floors and the medical floors. So it's really good. It only works with IRAs. It doesn't work with 401ks, 403bs, or 457s. It doesn't work with pension or profit sharing. You could roll it over to an IRA to make it work. You can't use a QCD to donate to a private foundation, a charitable trust, or a donor advised fund. But you can do it with a community foundation. So I'm on the board of the Greater Rochester Community Foundation. And you could do something like that, give it to the Greater Rochester Community Foundation, and then effectively make it like a donor advised fund without being formally a donor advised fund. You can use less or more than your required minimum distribution, but you can't do more than $100,000. And you can't get a benefit from the charity. You can't do galas or auctions or golf outings or those kinds of things. So be aware of that as well. So here's an example. Kim's 73. She normally takes $45,000 from her IRAs. She has other income of $68,000. That's got $28,000 of Social Security. She's got state and local taxes of $5,000, mortgage interest of $6,000, and she normally gives her charity $8,000. So we're going to consider doing a $24,000 QCD to a community foundation. It's going to suspend the remaining of the RMD. So if she hadn't done the QCD, her adjusted gross income would have been $113,000. And as her itemized and standard deductions would have been $19,000. Taxable income would have been $94,000. She would have had Medicare B premiums go up to $693, paid $15,900 in federal tax. Now what she does is she gives $24,000 to her charity. That saves her the next 3 years of next 2 years besides this year. Her itemized and standard deductions are $14,050. Her taxable income is $53,950. No IRMA floor. She gets around that floor and cuts her taxes. Look at her tax cut. She saves $10,000 in tax by using a QCD and suspending her RMD. Now, remember, she didn't take $21,000 of RMDs, but I would say to Kim, here's $21,000 you can take out of the bank. You save $10,000 in tax. Very unusual to save that much tax for that small amount of money. So donor advised fund is kind of fun. You donate now, distribute later. And I use one. So mea culpa, I'm always using my donor advised fund, and I like it. My donor advised fund allows me a current tax deduction, and I can designate donations in the future. I can give appreciated property. The donor advised fund grows tax-free. Depending on how much you give to one, you can invest it or have your professional advisor invest it as well. So you can go through and invest it during the different parts of it. I do mine and invested in some socially responsible funds because I kind of like to do double whammy on that. Subject to AGI limits, and you can individually invest the assets above the threshold, and it has to go to charities. You can't use donor advised funds for galas or pledges, so you got to be careful with that. But you can use it for a whole bunch of other things. And I've had people go through, well, I want to give some money to my college and get some U of M football tickets. I said, just don't make sure the football tickets aren't tied to it. Give it to something, and if you accidentally get some tickets cheap, then that's a different story. Do not tie them together. You can't have galas. You can't have pledges. Life insurance, you can use a life insurance trust to offset a set of charitable donations. So I could use a charitable remainder unit trust, which would pay me $50,000 annually. What I would do is I'd donate $1 million to my charitable trust. This is the Jim Cramer type thing. I'd get $50,000 a year for my trust. I'd get a $300,000 charitable contribution. I'm presuming a 64-year-old here. I use some of that $50,000. I buy an insurance policy for $1 million. And what happens is my kids then, when I die, gets the income and the estate tax free. I get $50,000. I get a $300,000 deduction. So my heirs are now getting, $400,000 of insurance. Everyone came out ahead. The charity got $1 million. The kids got $400,000. I got $50,000 a year. So kind of a everyone wins a little bit. And the insurance company made a little bit of money maybe on my policy. Here's one of my favorites, the Roth charity offset. And this is to use a charitable contribution to offset a Roth conversion. So, the 2020 limit on cash gifts, 100% of AGI, 30% on non-cash. I convert $100,000 of a traditional IRA to a Roth IRA. It creates $100,000 of income, and I offset the whole thing by a charitable contribution. And I could then potentially swap. So like I had indicated before, I can do some swapping and make a swap in there. By the way, if you have questions, just toss them up on the chat. I'll get to those in a moment as I pop back in. I'd like to just go through the presentation. I've already got a couple questions that I want to handle. I can use the charity offset to, all the way up to my charitable carryovers. I can use the offset to boost my adjusted gross income to get a bigger deduction. And I can contribute to a direct charity. I can contribute to a donor advised fund, to a charitable lead trust, charitable remainder trust, charitable gift annuity. I can even do remainder interest. So there's lots of ways to use the Roth. It's a weird thing. I'm seeing lots of possibilities, especially with higher income people, of manipulating their income up in 2020 because they've got all these things that are offsetting. And business owners are having net operating losses, but their business is still doing okay. There's this weird thing out there called a Paycheck Protection Program. And some of your nonprofits may have gotten those. And I already saw a question that somebody asked me on the nonprofits and the PPP. Recognize that is a potential forgivable loan. So that would be an interesting play as well. Tax-free growth, just important to see that funds will grow tax-free. A donor advised fund grows tax-free. Charitable remainder trust grows tax-free. Distributions are taxed. Private foundations grow tax-preferred, and charitable lead trusts are taxable entities. The grantor is taxed to the donor, and a non-grantor charitable lead trust is taxed to the trust. Things you want to think about, too, is asset placement post-secure. I just had a client that decided they were a pretty wealthy client. They had a significant amount of assets. They'd had a liquidity event. They wanted to give some money to charity. We sat down and talked about it. I said, well, you can give money to charity in your trust, but why don't you give your IRA to your charity? And that's exactly what they did. We designated their IRA using the charity as the beneficiary, and it saves an enormous amount of money. The kids now, under the Secure Act, which was passed last year, your kids have to pay taxes within 10 years of the date of your death, actually within 10 years of the year after the date of your death. So taking a look at that basic idea, the kids, your kids could be saving 37% plus state taxes available in California, 13% and maybe more by using the IRA going to charity and doing something else to the kids, whether it's life insurance, which is basically tax-free, or whether it's your house or whatever the case may be. It makes a lot more sense to potentially give the IRA to charity and give other assets to the kids. So potentially play with that idea as well. Kids versus charity, a gift of IRA to charity eliminates the income taxes. The retirement plan beneficiaries can be a public charity, which is a 501c3. It can be a private family foundation. It can be a charitable remainder trust. And this is an interesting one. Let's say I want to give the money to the kids, but my kids are not really responsible. I want them to be able to take the money over a longer period of time. I can actually make a charitable remainder trust my beneficiary of the IRA, and then the CRUT will pay the kids. So I could give the kids 5% of the IRA every year, and the charity gets the amount at the end of a period of time. So it's really interesting. 2 no's, don't use a charitable lead trust, and do not use the estate. Okay, important. By the way, all your clients with trusts are probably going to want to revise those trusts under the Secure Act. Good dialogue. Say, hey, if you've got a big donor, let's talk a little bit about estate planning. Your plan giving people in your nonprofit should be looking at some of these things as well. Kids versus charity splitting the IRA. The problem of a charity being a qualified beneficiary is one in there. So if you put the charity as a partial beneficiary of an IRA, so you have, a $1 million IRA, and you say, I want $100,000 to go to charity, and I want, $500,000 to go to my kids. Not good, because it actually screws up the payout, and it makes it a 5-year payout. The answer to that is go have 2 IRAs. So if you see my diagram here, it says, you got one IRA, part of it going to the kids, part of it going to the charity. Instead, what I do is I set up an IRA for the charity, I set up an IRA for the kids, and I've got a much better idea to do that. If you've screwed this up and it's all in one, you've got until September 30th of the year after death to make the distribution to charity. So I did have this happen recently where a client left $80,000 to charity in their IRA, I said, let's make the distribution right away. And we did, and we managed to preserve the assets for the kids. Roths are an undesirable charitable bequest. I suggest to people it doesn't make any sense to do a Roth. In fact, it even makes more sense to take the money out of a Roth and then donate the money in cash. So you want to leave traditional IRAs to charity and Roth IRAs to humans, and have taxable appreciated assets to humans. They get a step up, and taxable appreciation to charities during your lifetime. There is a possibility, unlikely but possible, that we could see a tax law change getting rid of the step up in basis, which means that if people had closely held businesses or other things, their kids would have to pay capital gains on those assets. I think that's something all of us in the nonprofit world should look at, and it's an important piece to play with. This is a little idea about the Secure Charitable Remainder Trust. This is using a charitable remainder trust as an IRA beneficiary. This allows us to stretch a much longer period of time, so we can give portions to the kids for longer than the 10-year period. The IRA grows tax-free. The charity does get the balance at the end of the period. So this works for people who are charitably inclined but like their kids and want to give some money to the kids. Obviously, you can change the beneficiary of an IRA anytime you want. So it's not like this is an irrevocable gift until your death. Once you die, it happens, and it's in there. A remainder interest gift. This is wild. Right now, the 75/20 rate is the lowest in history. It's 0.4%. So what happens is you're gifting a remainder interest after death. So you're making an irrevocable type thing. So let's say I've got a charitable gift of remainder interest of $1 million asset. It's a piece of property, a real estate up north or something like that. Or a 59-year-old. If I'd have made that gift, a charitable gift of that remainder interest in May of '89, it would have been $156,000. In October of 2020, it would have been $915,000. That's just crazy. And these rates are the lowest in history. I've never seen an opportunity for remainder interest gifts like they are now. Usually, farmland, homes, things like that. You don't want debt. Can't have debt on the property. You don't want to do something that's got lots of, unrealized business income. But if somebody had some land or they wanted to give a charitable easement or some of those things, this would be the time to do it. Interesting one on charity. Certain taxpayers and pass-through entities have income limitations. These would be people who are in specified service trade or businesses. That means like doctors or veterinarians. And there's limitations on how much they can have in terms of their qualified business income. $326,600 for a couple, or a single person, $163,000. So let's say I have my veterinarian who probably does make $188,000 because I have horse and dogs and cats and all kinds of other stuff. So Sue's a veterinarian. She's single. She has $188,000 of income. Under the QBI rules, she's over the threshold by 50%. So she loses $32,000 of deductions, usually half of her deductions. So she's losing $16,300. If she makes a charitable donation of $25,000, it brings her income down, and she gets a deduction for that $25,000. And it restores her qualified business income, $16,000. She gets $41,000 of deductions from a $25,000 contribution. Now, she doesn't get $41,000 of tax benefit, but she does get $41,000 of deductions. Kind of interesting, a double bang. So if you have donors that own pass-through businesses, doctors, lawyers, Indian chiefs, entertainers, CPAs, those folks can kind of play with this QBI. By the way, being a nerd, a tax nerd, us tax nerds love to talk to people in the nonprofit world that can speak our language. So speaking the language of the folks makes a big difference. One of my favorites right now, and the one I'm seeing a massive amount with, is 75/20 rate in the CLATs, the Charitable Lead Annuity Trusts. And this is where you make an annual payment to the charity with an annuity based on the 75/20 rate, that 0.4%. You give all the excess appreciation to the heir. So I just did one of these for $1 million. What we did is we donated $1 million to a Charitable Lead Annuity Trust. The charity got $52,230 a year. We got $1 million for 20 years. We got $1 million tax deduction. We have it in assets that we think will make 6%. The kids get $1 million too, but we paid no gift tax. We paid no estate tax. We didn't use our exclusion. We passed the money, the $1 million to the kids, got $1 million tax deduction, and gave our charity $53,000 a year. Really like the charitable lead. So, $1 million to the CLAT, $52,127 for 20 years, 0.4% rate, $1 million present value, 0% remainder, $1.2 million to the kids. You can do different results too. I could give $1,250 in the first year, and then increase it 75% each year. Or I could give $10,000 for 19 years and $810,000 in the 20th year. You can play with the CLAT, and you can make different examples down the line. Somebody asked me about PPP loans. There is some stuff going on with PPP loans. I know some of the charities out there did get PPP loans. If you're under $50,000, there's automatic forgiveness. It's my suggestion, since you don't have a deductibility issue if you're a nonprofit, to go ahead and apply for forgiveness. Just go for the forgiveness. There's a short form for forgiveness that you can get on the SBA site. Just automatically forgives the PPP. So it's like a $50,000 piece in there. I would work on that. Somebody asked, are we going to get another re-upping of the PPP loan? It appears yes, but probably not until after the inauguration. So I would say something we should pay attention to on that one. Sorry again for the audio loss. A couple folks did want to know, someone wanted to know, sent me a private chat on making contributions of appreciated stock. I do think this is a grand time to go ahead and make do some things on appreciated stock. This would be the one to go ahead and do. So if you got any other questions, throw them on the chat for me. Love to hear them. I've got other questions. Hi, Tara. I see you're back on. Glad to hear that. Hi, Wendy. Hi, Susan. And hi, Misty. Good to see everyone on. If there's any other questions, I'd love to do that. Yeah, Danielle, you want to know about bunching? Bunching basically says this: I take my charitable contributions that I'm going to make in a specific year, and I accelerate them. I either use a donor advised fund, so I make 3 years contributions into a donor advised fund, and I get a bigger deduction this year. So let me pop back to my example. Let's see if I can roll over to that bunching example. Here's bunching for fun and profit. So these people have $10,000 of SALT deductions, $10,000 of mortgage interest. They normally give $4,000 to charity. They're under the $24,800. They're under their limit for the standard deduction, because I've got $24,000 instead of $24,800. So they're not getting any deduction for their $4,000. If they bunch $12,000, in other words, 3 years worth of contributions in a donor advised fund, they'll get a deduction of $32,000. In other words, they get a much bigger benefit. And then obviously for 2021, they use the standard deduction. 2022, standard deduction. So they itemize in 2020, standard, itemize, standard, bunch, don't. So that's the idea. Squeeze it into one, take it out later. And let me pop that off. Back to our regularly scheduled show. Good, you got it, Danielle? Great. Any other questions we've got for anybody? I would love to hear your thoughts. Hopefully, was this useful? I hate to be too much of a nerd, but I want to make sure that we get some good time. We got a few more minutes left, so I'm open to other questions. Markets, outcome of the election. Yesterday is an interesting type thing. We saw a lot change yesterday. Everybody thought, wow, the pandemic is over. Interesting games yesterday. The worst stocks in the market were Zoom and Clorox and Home Depot and Lowe's. They didn't do very well at all yesterday. Everybody said, oh, good, we're not in the COVID anymore. Not paying attention to the experts all talking to all the things that are in there. So I can tell you that we're not done, but this the fact that we're reaching the end of the tunnel with some light at the end of the tunnel, really, really good. Thanks, Danielle. You said it's fast and furious. That's just the way I roll. Sorry about that. I'm there. Karen, yeah, we can get you copies of the slides. Tara's going to get those for us. Tara, you got any good questions for me? You're always full of grand questions. I'm obviously of the opine that this is a great time for nonprofits to have dialogue. This is a great time to be talking to clients. Planned giving, if you get to people like me and talk about planned giving, we are really, really hitting on the planned giving side. We have been talking to our clients, and the reason is we're seeing a lot. It's fairly evident from this year that things can change dramatically, and the estate tax exclusion goes back in 2025. If you got people in high net worths, that's going to make a difference. If you got people with closely held business, that makes a huge difference. So this is the time to go look at planned giving. Our planned giving things range from the easy stuff like donor advised funds that we'll do and work on donor advised funds. And I have a great relationship with a couple of the custodians, Schwab and Fidelity, where we can do donor advised funds of things like cryptocurrency, or you can do donor advised funds of real estate, closely held businesses, all those kinds of wild things. So you can take it from a donor advised fund all the way up to these in these crazy fun ones like the Clats and the Krats and the Kruts. We had a client that had a huge amount of concentrated stock. They were, a big time executive in a company that was publicly traded. We donated that publicly traded stock to something called a flip crut, and we hung on to it as it went up in value. And this year it hit a huge value. We sold it inside the flip crut tax free and gave the income back to the retiring executive. It was really wild. We diversified ourselves away from the concentrated holding, and we got the client income, and we got a tax deduction. So big time benefits coming out of plan giving. This is the time. So I think all of us could still, I gave you a lot of things, $300 or millions. I like to play with, there are a lot of people who are charitably inclined. I have a client that gave $2 million this year to a donor advised fund. I mean, because we could have done all kinds of other things, but they just said, no, I just want to do donor advised fund, $2 million, go invest the money for me. And it's fine with us. And we took care of it. So I am seeing big donations come back into play, but you got to have some creative statements for what you're going to do with it. One more just non-sectarian view of things. I do donations. I like to see bang for my buck. I don't like just being asked for money per se. When I do, I usually round down or something. I know I sound, pedestrian about that, but I would rather round up when I knew what I was donating to. So for example, when I give to OCC, I like to give them the amount of tuition. Or if I'm giving to Walsh, I like to give the amount of tuition. I think if you can quantify or personalize or tell the story or tell the tale of what the donation is doing, it makes a bigger difference. So it's a much bigger difference. So I would say, try to personalize and try to personalize the charitable donations. A couple of things to think about on the plan giving side as we wrap up, and then again, feel free to pop me any more questions, and Tara, feel free to shoot one over if you'd like. I just like all of you to think about a couple of things as you're going down the line. You do probably have clients who also got PPP loans, and this is going to give you an opportunity. They're going to have some funds, and maybe they didn't have an unsuccessful year. So there is all kinds of things happening in this year that makes a difference. One that has come into play is because of the charitable limitations on taxable income. You can now go to corporations for larger donations as well as individuals. So this is if there's ever going to be a year where you want to sharpen your pencil and go learn some tax rules, this is the year. That's the good news. The bad news is you got about 50 days to go do these things. One last thing I run into, just a word to the wise. If you're going to make donations to accounts, like if you're going to donate to a Fidelity fund or a Schwab fund or whatever that, do it around Christmas. Give yourself, it's T+3. You want to give yourself 3 days, 3 business days. So, wrap up your donations earlier than later. I got stuck on one where we ended up, somebody on December 31st was trying to donate some stock, and we just couldn't get it done. And we ended up losing the charity, and it was because the charity had talked to the person and somebody dropped the ball at the charity and didn't go back and get the person to make the donation. So I think it would be really valuable if you did those things. Pop me another question if you like. Otherwise, I'll give you back 3 minutes of your day. I always appreciate everything we do from the Troy Chamber. I got one in here. When a person gives a plan gift, do the charities get any notice? It can be done without the charity's knowledge. Almost always you want to tell the charity. I always tell the charity we're going to do it. I want to work with them. When I'm giving a plan gift like a charitable remainder trust, I have to do that. I have to go to them and say, you got to accept the gift. So if I'm doing a donor advised fund plan gift, no big deal. The charity doesn't need to know about it. I have had scenarios where my charities have ended up with one. We ended up with one with the Ronald McDonald Foundation that was amazing. It was a great, gigantic one. We didn't expect it. We were surprised. In fact, I got the notice because I was remanaging the account and called the head of the foundation and said, "Hey, are you driving?" She said, "Yeah." I said, "Pull over. Got some good news for you." So we as advisors almost always talk to the charity ahead of time on what we're going to go do. If it's donor advised fund, you don't have to talk to the donor advised fund. They'll accept the security and accept the planned gift. But you could surprise the charity, but I'm not necessarily thinking that's a big one. We did have one weird case where I had a client that had $1 million they wanted to give away. They named a set of charities at $100,000 a piece. And I had the wonderful task of giving each of those charities $10,000, 10 charities, $100,000 a piece. It was really fun. I remember calling up Leader Dogs to the Blind and said, "Hey, I have a gift for you guys. I want to give you from one of my clients." And they said, "Oh, cool, that's great, well, really nice. How much is it?" It's $100,000. Actually, I said it's actually 102,300 because we made some money and wanted to give it in there. So anyway, I'm going to leave you all, I think, now. Everyone stay safe. And I just want to thank the Troy Chamber for allowing me to be a member and to be with you. And thanks again to the Nonprofit Management Conference and Susan and John and Karen and Elizabeth and good old Jimmy Guizdala and Danielle. Thanks a lot. And if there's anything I can do, feel free to connect with me. Give me an email, drop me an email. Tara will get you the slides. I also am available on LinkedIn. So if you want to connect on LinkedIn, always happy to share information with everybody. So thanks, everybody. Take care. Bye-bye.